Global developments impacting oil prices, economy, and inflation. What it means for everyday people.
Join our YouTube community. Be part of our YouTube journey. Subscribe now. Get exclusive content, stay updated, and join a community of like-minded enthusiasts. Please subscribe for $1,000 early bird draw.
The recent conflict ignited by Hamas' surprise attack on Israeli civilians has raised concerns about its potential impact on oil markets. Historically, such events would have sent oil prices soaring, but this time, the effect was short-lived and viewed as a blip by most analysts. This can be partly attributed to the evolving landscape of the oil market. The United States, as the world's leading oil producer, now holds a substantial influence over its domestic oil supply, and its strategic petroleum reserves provide a safety net against abrupt price spikes, albeit at a reduced capacity. Iran emerges as a significant wildcard in the current situation. As Israel's most potent adversary and a notable player in global oil markets, Iran's involvement in the conflict could considerably disrupt energy markets. While the U.S. might tighten sanctions on Iran, reducing its oil exports and leading to price increases, this would still only have a limited impact on the overall oil market, given that Iranian exports make up less than 1% of global oil supply. A more extreme scenario, such as Iran blocking the Strait of Hormuz, could result in a dramatic surge in oil prices. In the absence of significant changes in the ongoing conflict, the passage suggests that oil prices are likely to fluctuate within a range of $80 to $95 for the remainder of the year. This resilience of the energy market in the face of geopolitical tensions suggests its ability to adapt and withstand disturbances. While the world's attention is currently focused on the Israel conflict, the energy market seems to have shifted its gaze elsewhere, at least for the time being. The International Monetary Fund, IMF, has projected a soft landing for the global economy, driven by easing inflationary pressures. In its World Economic Outlook at the IMF and World Bank annual meetings, the IMF forecasts 3% growth for this year and 2.9% for the next, a downgrade from its earlier projection of 3% for 2024. These figures are notably lower than the 3.5% recorded in the previous year and well below the historical average. However, there is a glimmer of optimism in the IMF's projection, particularly centered on an improved outlook for the United States. The IMF has raised its growth forecasts for the U.S. to 2.1% for this year, up from the July estimate of 1.9%, and a 1.5% increase for next year, up from the 1.0% forecast. The fragile growth outlook faces potential challenges. The IMF has highlighted risks related to more volatile commodity prices, driven by climate and geopolitical shocks, which could jeopardize the soft landing scenario achieved through easing inflation. These concerns have intensified following the recent conflict between Hamas and Israel, which could result in energy supply shocks, raising oil prices and impacting global growth. Additionally, the IMF has revised down its estimates for Europe and China. The euro area is projected to grow at a slower rate, and China's growth momentum post-COVID is fading, with economic troubles spreading to real estate developers. These challenges in China could have a wider impact on the global growth outlook, especially as they coincide with declining real estate investment and housing prices, straining local government finances. The IMF suggests that substantial stimulus measures are necessary to address these issues, emphasizing the need to clean up the real estate sector in China. However, challenges with property developers like Country Garden indicate that Beijing may have different strategies in mind, potentially involving economic stimulus or confidence in the underlying economy. Copper prices have experienced a significant decline, dropping to $3.70 per pound, a 13% decrease from their late January high of $4.27. This decline is primarily attributed to a global economic slowdown, with Germany facing a recession due to high inflation and interest rate increases and China's economic growth decelerating. Copper prices are sensitive to reduced demand resulting from lower economic activity, affecting sectors such as automakers and home builders. Copper, often referred to as Dr. Copper, on Wall Street, is closely watched as a barometer of the global economy's health. The recent drop in copper prices is seen as a signal of fear regarding the economy, according to Colin Fenton, head of commodities research at 22 Volts Research. However, there is a glimmer of optimism as copper prices have found buying support at around $3.63 per pound, suggesting that the economic outlook may not be dire enough to push prices lower. The copper market is closely monitoring when the struggling economies of China and Europe will stabilize, with hopes that addressing inflation could boost demand. Additionally, it is keeping an eye on how the U.S. economy responds to higher interest rates, noting that U.S. consumer spending has continued to grow in 2023 despite increased rates. In the near term, the focus lies on key support levels between $3.57 and $3.62 per pound. A successful hold at these levels could lead to a copper recovery, signaling a potential relief rally in broader risk assets. However, a violation of these support levels would be seen as a negative signal for global markets. In summary, while lower copper prices may indicate economic concerns, there are indications that the global economy is still holding up, contingent on several key factors and support levels. European Central Bank President Christine Lagarde has provided insights on the state of the Eurozone's economy during the International Monetary Fund's annual meetings in Marrakesh. She noted that core inflation in the Eurozone remains elevated, underlining that the fading impact of earlier surges in input costs is being balanced by rising labor costs. High wage growth was highlighted as a consequence of employees seeking compensation for their reduced purchasing power amid tight labor markets. She further indicated that inflation is projected to slow to the 2% target by 2025, with a forecast shared by officials following their September 14 meeting. Lagarde also addressed the expected trajectory of wage growth, suggesting that it will gradually decline while remaining high over the projection horizon. This decrease is anticipated due to increases in minimum wages and inflation compensation, within the context of labor markets that are cooling but still tight. Lagarde emphasized the need to assess the impact of prior interest rate increases, as potential downside risks include weaker demand and a more robust transmission of monetary policy, both of which could impact the economy negatively. On the other hand, growth could surpass expectations if the strong labor market, rising real incomes, and reduced uncertainty boost confidence among consumers and businesses, leading to increased spending. In another discussion with central bankers from the Group of 30, Lagarde underscored that the ECB has not reached a point where it can declare its mission accomplished. She stressed the importance of patience, especially as supply shocks reverse and new shocks emerge. Lagarde also highlighted the need to ensure that inflation expectations remain anchored when inflation remains too high, emphasizing the importance of remaining attentive to the evolving economic environment. For the everyday person, recent conflicts seem to have had a limited impact on immediate oil prices, potentially resulting in stable energy costs and gas prices. The IMF's projection of a soft landing for the global economy offers hope for economic stability, which could translate into lower inflation and positive financial outcomes. However, elevated core inflation and high wage growth may continue to impact the cost of living, necessitating attention to economic trends and policy decisions for informed financial planning.